Hi, my name's Eric, and this is the Audible Local Ledger's Reading for the Blind of Barrons Magazine. The Barrons issue date is January 27th of 2025. And we'll start with Up and Down Wall Street by Ben Levison. Trump will take investors on a bumpy, if prosperous, ride. Sometimes the planets quite literally align. For investors, this isn't one of those times, but it might just work out okay anyway. If you looked up into the night sky this past week, you might have seen a planetary parade as Venus, Saturn, Jupiter, Mars, Uranus, and Neptune lined up in a way that isn't uncommon, but also not pedestrian. It's the kind of sight that inspired ancient civilizations like the Babylonians and Mayans to seek omens about the future, both good and bad. Today it's a phenomenon that might open our eyes to the wonders of the universe, if only for a fleeting moment. If only the drivers of the financial markets were in similar sync. In the best of times, the government, monetary policy, and the economy pull in the same direction, helping corporate profits rise and stock valuations increase. But this isn't one of those times. The economy, though strong, still has an inflation problem, one that's forced the Federal Reserve to back away from what promised to be a steady series of rate cuts in 2025. The re-election of Donald Trump has introduced an element of chaos that has the potential to shake markets or lift them higher. The stock market, then, is left not to climb the proverbial wall of worry, but to navigate a swamp of uncertainty. How Trump decides to attack taxes, tariffs, the national debt, and immigration will result in wilder gyrations than we've been used to during the past couple of years. Expect increased noise and volatility surrounding the incoming administration's new policies. But these are the four main areas whereby those policies could impact the markets and the economy, writes Sevens reports Tom Essay. Market volatility is often a reflection of what investors think they know. When the path ahead looks relatively certain, investors get comfortable. Some would even say complacent, and don't feel the need to make big changes in their positions. But when something unexpected happens, it results in a mad dash to reflect the new information in trades and portfolios. Too many scares, and volatility rises. Between the economy, inflation, and the Fed, investors are already dealing with plenty of unknowns, plenty of known unknowns. Making sense of it all will be complicated with a wild card like Trump in the mix. Anyone not plugged directly into the new administration will have difficulty assessing the macro outlook, because policy shocks are likely to be dominant here, writes Gerard McDonnell, an economist at 22V Research. Investors got a taste of Trump's potential impact on the market this past week when he did the unexpected. On Tuesday, for instance, stocks soared after the president refrained from placing tariffs on China, Mexico, Canada, and other U.S. trading partners, or deporting millions of immigrants during his first day on the job. Tech shares got a big boost on Wednesday when Trump touted Stargate, a $500 billion joint venture between Oracle, SoftBank Group, and OpenAI to build AI infrastructure across the country. By Thursday, he was helping boost Bitcoin with talk of a national reserve and accusing Bank of America CEO Brian Moynihan of debanking conservatives. Its shares rose 1.3%. He also caused oil prices to sink after saying he would press OPEC to let them fall to hasten the end of the war in Ukraine, even as the S&P 500 index rose to a new all-time high. The intraday swings in oil, which were lower, and stocks, which were higher, underscore market volatility accompanying Trump version 2.0 as the president rolls out policy and riffs on all things econ, political, and markets, writes Evercore ISI strategist Julian Emanuel. If these moves and comments were an amuse-bouche, then the main course is still to come. They range from proposed tariffs of 10% on Mexico and Canada that could arrive as early as February 1st to a crackdown on illegal immigrants that's just begun. Some of Trump's goals, like the promise to lower corporate tax rates to 15%, depend on congressional approval. And that approval doesn't seem like a sure thing, given the deficit hawks in the Republican Party and disagreements over strategy. If the moves don't materialize, expect the markets to be very, very disappointed. While Trump's policies create landmines for investors to dodge, they also have the potential to act as fuel for the stock market's rally. The market should get a lift from Trump's artificial intelligence policies, writes John Higgins, chief markets economist at Capital Economics. While the efficacy of Stargate remains to be seen, there's little doubt that Trump intends to ensure the U.S. remains the leader in AI. That'll be good news for big tech, whose earnings should continue to get a lift from AI spending, but also for a market on the whole as non-tech companies begin to see the benefits of the new technologies providing, something that could lift the entire S&P 500. Trump's attitude toward AI reinforces our view, and we're sticking to our forecast that the index will end 2025 at 7,000, Higgins writes. It won't be a straight line, however. Over the past 5 weeks, investors got a preview of what the stock market could look like under Trump. 2 weeks ago, the mood was bleak. Economic data was coming in too hot. Investors were worrying that inflation was about to roar back to life, and the Fed suggested it might have reached the end of its rate-cutting cycle. Trump had yet to take office, and his promised tariffs and deportations had the potential to shake investor confidence. With the market priced to perfection, the S&P 500 dropped 4% from December 18th through January 10th. What a difference 2 weeks makes! The economy remains strong. It's expected to have grown at a 3% clip in the fourth quarter, according to the Atlanta Fed's GDP Now tool. But December Consumer Price Index contained nothing to suggest that inflation was set to re-accelerate. Fed Chair Jerome Powell seems unlikely to disrupt a good situation when the central bank meets on January 28th and 29th. Fourth quarter earnings season has also started off strong, with companies beating estimates by an average of 8.7% through Thursday. No wonder the S&P 500 gained 1.7% this past week after closing at a record high on Thursday. The shift in mood from optimism to misery and then back again was abrupt. Sentiment traders Jason Gopfert noted that the ratio of bullish respondents in the American Association of Individual Investors survey plunged below 40% for the week ended January 15th, only the second time that's occurred since May of 2023. The S&P 500 has been higher 72% of the time in the 6 months following such declines and 79% of the time in 12 months later, according to Sentiment Trader data. Investors were feeling much better in the survey released on January 23rd. The percentage of bullish investors rose to 43.4% from 25.4%. But even quick recoveries in optimism have typically been followed by stock market rallies. Compare the change in the CBOE Volatility Index, or the VIX, VIX, which reflects how wild the next 30 days of trading are expected to be, to historical volatility, or the size of the swings of the previous 30 days. On December 18th, the day the Fed hinted at the possible end of rate cuts, the VIX surged to 27.6 from 15.9. By January 17th, it had fallen back to 16. Over the same period, realized volatility ticked up just a few points. That kind of drop in the VIX relative to actual volatility doesn't happen very often, but when it does, it's historically been good news for the stock market. The S&P 500 has gained a median of 3.8% over the following 3 months, 7.2% over 6 months, and 13.5% over 12 months after similar events since 1990. In other words, the odds favor the bulls. Don't be surprised if the wild mood swings continue. In this kind of environment, investors should continue to favor the companies that benefit from policy goals that are unlikely to change. Trump's deregulatory push could see the industries that operate under the tightest restrictions get a boost, and it doesn't need approval from Congress. Manufacturing, which has seen productivity decline since the financial crisis, could also get a boost if it starts to close the gap with the services economy, according to Societe Generale's Manish Kabra. He also recommends regional banks, the riskier the better, and small-cap stocks whose size make regulations feel particularly onerous. Trump's energy push might not be great news for oil explorers. It could boost supply and lower prices. But it will be great news for companies that benefit from increased spending on production, Cabra writes. For retail investors, that could mean favoring the Van Eck Oil Services Exchange Traded Fund, their ticker is OIH, over the SPDR S&P Oil and Gas Exploration and Production ETF, whose call is XOP. The Stargate announcement is a signal that the AI trade should continue to pay off. Investors have been worrying companies will start spending less on AI infrastructure, but the announcement should be seen as a sign that demand's very much alive and well. NVIDIA should be a big beneficiary, says Melius analyst Ben Reitzes. He notes that on the high side, NVIDIA could receive more than half of the $100 billion to be spent during the first year of the program. He also argues that Broadcom and Arista Networks should get a boost from the spending on networking, while Oracle could benefit as well. We certainly don't have this kind of spending for CapEx, nor have this kind of cloud revenue in our current model for buy-rated Oracle, who's a big beneficiary, Reitzes writes. Oracle stock gained 14% this past week. In a volatile world, gold also looks like a good bet. The precious metal has gotten a boost from central bank buying as countries, particularly those with adversarial relationships with the U.S., look to expand their reserves out of the dollar. But gold also benefits from a lack of fiscal discipline in the U.S. and elsewhere. While the U.S. deficit hasn't been an issue yet, the continued expansion of debt to gross domestic product should be another tailwind. Macro Intelligence 2 Partners also notes that gold's recent slumber, its dip 0.2% since peaking October 30th, likely caused investors to sell in favor of other assets. With the price starting to show signs of life again, if these sellers want their positions back, they're going to have to chase the price, the firm writes. Well, maybe the planets have aligned after all. Next comes the Streetwise column by Jack Huff. A surprise in earnings surprises. We look at 5 beats and 3 misses by Jack Huff. It's too late for an earnings season preview and way too early for a review, so consider this a pre-review. The numbers look good, maybe even surprisingly good, and that's not a word I throw around willy-nilly. The classic definition of an upside earnings surprise is when a company beats Wall Street's consensus estimate. But in recent years, that's happened around 3/4 of the time. Most of these surprises, quote-unquote, reflect companies and analysts carefully managing investor expectations to beatable levels, not business results wowing. That's reflected in stock reactions. Over the past 5 years, in cases where companies beat both earnings and sales estimates, their shares rose in response by an average of less than 1%, and it's unlikely that investors are underreacting. There used to be a trading phenomenon referred to as post-earnings announcement drift, or PEAD, P-E-A-D. It was first documented in the 1960s. After upside earnings surprises, stocks would tend to continue beating the market for many months. But PEAD has vanished, and as upside surprises have turned ordinary. Just over a decade ago, a study found that the combination of earnings surprises and immediate price jumps was a solid predictor of handsome returns over the following months. Ordinary investors would find it difficult to turn into a buying strategy, and algorithmic traders might have already exploited it into oblivion. But I take the finding to mean that a surprise is only a surprise if it comes with a big price move. Recently, many companies have delivered just that. In cases where companies have beaten both earnings and sales estimates, their shares have gained an average of 3.6% in response. That's more than usual. Misses are getting punished more than normal, too. Overall growth is solid. The blended fourth quarter growth estimate for the S&P 500, actual results plus remaining estimates, has been nudging higher, thanks to widespread and large upside surprises, and it's approaching 13%. With the index trading at 25 times earnings, peppy growth seems like a box that needs to be checked right now, and so far companies are checking it. Let's run through a handful of recent earning thrills and spills. GE Aerospace on Thursday gained 7% after reporting a 16% rise in revenue. excluding results from a legacy insurance business that the company is running off. Orders jumped 46%, and earnings per share more than doubled. GE has more demand for its LEAP engines than it can handle, and there's been progress on deliveries, with JP Morgan predicting a 19% rise there in 2025. Amphenol, Amphenol, makes connectors, sensors, cables, antennas, and other doodads. On Wednesday, shares rose 7% when the company reported 30% fourth quarter revenue growth in U.S. dollars, or 20% not counting acquisitions, driven by strong demand from data centers, commercial aviation, and industrial customers. Truist Securities analyst William Stein wrote that he needed to get out the magnifying glass to find weak points. They were largely in Europe. Netflix was the talk of Wall Street on Tuesday, reporting record fourth quarter subscriber growth, sending its shares up 10% the next day. Growth initiatives include advertising, cloud gaming, and live events. The company's advantages over legacy media looks likely to grow from here. At a time when rivals are cutting costs, Netflix plans to increase content spending in 2025 by $1 billion to $18 billion and still turn out about $8 billion in free cash flow, up from $6.9 billion. Evercore ISI calls the recent mix of earnings beating estimates surprisingly broad, quote-unquote. Big banks mostly thrived during the fourth quarter on higher interest rates and rising fees on investment deals. Blowout results for Delta Airlines came from both leisure and corporate travelers, with momentum picking up throughout the fourth quarter. November and December had 4 of the top 10 revenue days in company history. Carnival has had an odd fiscal year that runs through November, so it reported its results in late December. But they were strong enough to warrant calling out here. Adjusted net income came in at triple management's guidance. For example, for 2025, Carnival predicts 20% earnings growth and says that 2/3 of the business is already booked. The company will soon open a private Caribbean island, something that's paid off richly in recent years for rival Royal Caribbean. There have been some earnings flops. Wild swings in consumer demand around the COVID-19 pandemic left the freight industry in a long slump. On January 16th, trucker J.B. Hunt Transport Services missed their earnings estimates and gave rare guidance well short of expectations. Shares fell 7%. Susquehanna financial analyst Bascom Majors, who's bullish on the stock, wrote that the outlook could come close to clearing the decks after a facing off versus optimistic "the recovery just around the corner" forecasts. On January 10th, brewer Constellation Brands reported an earnings shortfall that sent its shares 17% lower. The company, which distributes Corona and Modelo in the U.S., has been a rare grower among big beer brands, and its stock is traded at a premium to the group, so high expectations might have played a role. On the earnings call, management dismissed concerns that a broad downward trend in alcohol consumption is hurting business. 2 analysts downgraded the stock. But the biggest miss of late came from Lamb Weston, which makes French fries. Back on December 19th, it missed Wall Street sales and profit estimates by large margins, sending shares down 20%. The company replaced its CEO with its former COO. Activist investor Jana Partners called the financial results disastrous, and the management changed to another insider a stick in the eye. Lamb said on the earnings call that hamburger chain traffic dipped during the quarter. Asked if obesity drugs were playing a role, management said it wasn't seeing that. It blamed inflation and promotional deals that include small-size fries. Too many customers, it said, are trading down from medium. From the review and preview section of Barrons Magazine for January 27th, mid-caps in a sweet spot. With uncertainty over interest rates and stock valuations, 2025 could be the year of the market's forgotten middle child, mid-cap stocks. While mid-caps don't get much attention, the sector, those are companies with market values between $2 and $10 billion, may be in the sweet spot. The large cap S&P 500 index trades at nearly 22 times 2025 earnings, near a 20-year high. The iShares Core S&P Midcap Exchange Traded Fund at 16 times. Analysts forecast 13% 2025's earnings per share growth for the ETF to the S&P 500's 14%. It's midcaps' time to shine, wrote B of A Securities recently, noting that midcaps with comparatively strong balance sheets should weather rising rates better than alternatives like small caps. J.P. Morgan saw President Trump's tariffs lifting domestically focused companies, advantaging small and mid-cap stocks relative to multinationals. One stock highlighted by J.P. Morgan is fruit company Dole, which trades at 9 times 2025 earnings and FactSet says should grow earnings by some 15% this year. JPM cites the stock's 12% free cash flow yield and rapidly delivering balance sheet. Timothy Schwartz, co-manager of the Schwartz Value Focused Fund, Morningstar's top mid-cap blend fund in 2024 with a 39% return, likes mid-cap outdoor products maker Yeti Holdings, which had a big run after going public in 2018, then struggled. At 13 times 2025 earnings, it's overlooked by the market, he says. That was reported by Ian Salisbury. Last week, in Review and Preview, in markets, the Trump inauguration moved inside the Capitol with Washington gripped by cold. A ceasefire began in Gaza with the first hostage and prisoner exchanges. President Trump, who the weekend before launched his own meme coin, followed by the First Lady, that sent crypto falling, signed executive orders, including a 75-day TikTok reprieve, tariff threats, pardons for January 6th participants, ending AI regulation, demanding lower prices, and sending troops to the Mexican border. The dollar fell, then rebounded. Markets rose after the MLK break. The S&P 500 hit its first record high of 2025 on Thursday. Shares fell Friday. On the week, the Dow Industrials rose 2.2%, and the S&P 500 and Nasdaq Composite gained 1.7%. In companies last week, Apple's fourth quarter iPhone sales fell 18% in China. Trump presided over the announcement of a $500 billion AI infrastructure venture led by OpenAI, SoftBank Group, Oracle, and UAE-based MGX called Stargate. Elon Musk scoffed at the plan. The Financial Times reported that TikTok parent ByteDance would spend $12 billion on AI infrastructure this year. Moderna received $590 million in federal funds to develop a bird flu vaccine. Netflix added 19 million subscribers in the fourth quarter. In deals, Saudi Arabia's investment mining fund is set to buy 10 to 20% of Barrick Gold's $9 billion Pakistan copper gold mine Reko Diq from the Pakistani government. And Italian bank Monte dei Paschi made a $13.9 billion offer for rival Mediobanca. What's ahead for this week? On Monday, the 27th, a crowded earnings calendar is headlined by big tech reporting midweek. AT&T announces quarterly results Monday, followed by General Motors, Lockheed Martin, RTX, and Starbucks on Tuesday. ASML Holding, Meta Platforms, Microsoft, and Tesla release earnings on Wednesday, while Apple, Caterpillar, MasterCard, and Visa follow suit on Thursday. AbbVie, Chevron, ExxonMobil, and Novartis close out the week on Friday. On Wednesday, the 29th, the Federal Open Market Committee announces its monetary policy decision. The FOMC is widely expected to keep the federal funds rate unchanged at 4.25% to 4.5%. With the economy and labor market still resilient and inflation stubbornly above the Federal Reserve's 2% target, the central bank is in wait-and-see mode as it assesses incoming economic data. On Friday, the 31st of January, the Bureau of Economic Analysis releases the Personal Consumption Expenditures Price Index for December. Economists forecast a 2.5% year-over increase, 1/10 of a percentage point more than in November. The core PCE index, which excludes volatile food and energy prices, is expected to rise 2.8%, matching the November figure. And the numbers: $1.5 trillion. That's the global net inflows of exchange-traded funds in 2024, beating the previous high in 2021 of $1.2 trillion. $4.15. I'm used to trillions and millions, folks. $4.15. That's the average retail price of a dozen large eggs in December. That's up 14% from November, 37% for the year. $30 billion. That's redemptions made from climate-focused mutual funds last year, ending 4 years of increases. And $1.8 trillion, that's the amount of fees hedge funds charged investors since the industry began. That's 49% of the total gains. And our cover story, High Interest Rates Loom Large by Randall Forsyth. Rising rates would be bad news for bondholders and borrowers of all stripes, particularly the U.S. government. They cast a shadow over stocks, too. For both bondholders and borrowers, the pain of higher interest rates may have only begun. President Donald Trump will have to decide if he wants to be part of the problem or part of the solution. Many of the political promises that got him elected, including tariffs, tax cuts, and heavy government spending, could push interest rates higher. The bond market has gone through one of its most wrenching periods in history, capped by plummeting prices late last year and in early January. Housing has suffered a double whammy as new homes have become unaffordable for many buyers facing 7% interest rates on mortgages, which take their cue from bonds. And prospective sellers are frozen in place rather than trading their old 3% loans for much costlier ones. The U.S. Treasury, the world's biggest borrower, has felt the pressure of higher bond yields most acutely. After running budget deficits previously only seen during wars or recessions, the U.S. government's total debt has grown larger than the U.S. economy. When it could borrow at rates under 1%, this debt appeared manageable. At current borrowing costs, the government's interest tab is the fastest growing part of its budget, surpassing defense expenditures in 2024. To bond investors, who are Uncle Sam's lenders, this burgeoning debt points to still higher interest yields and lower bond prices in the years ahead. That growth is driven by ongoing deficits totaling 6% of gross domestic product, which in turn are boosted by surging interest expense on existing and new debt. High rates are hammering borrowers. Lower quality companies, especially those that rely on bank loans and private credit, are seeing increased credit stress. Commercial real estate is in a tightening vice, as old, low-cost loans have to be refinanced at higher rates, while sectors such as office buildings remain depressed. And then there's the stock market. Equities will suffer if bond yields keep heading higher. Late last year and into early January, stocks stumbled as the yield on the benchmark 10-year Treasury note shot up from 3.6% to 4.8%. Then equities rallied as the Treasury yield fell back by a quarter of a point on better than expected inflation news. The S&P 500 index hit another record this past week. Interest rates are also front and center for President Trump. In a Thursday video address to the World Economic Forum in Davos, Switzerland, Trump said he would demand that interest rates drop immediately in a public signal to the Federal Reserve. The problem is that the bond market may not follow the central bank's lead this time. When the Fed cut its federal funds target by 100 basis points late last year, the 10-year Treasury yield did the exact opposite, rising to its recent peak. Regardless of Trump's dictates to the Fed, the bond market is likely to price in more uncertainty because of the inherent contradictions among many of Trump's policies and the volatility around their application, for example, tariffs, and still too large budget deficits, writes Stephen Blitz, chief U.S. economist of T.S. Lombard. Blitz thinks 10-year Treasury yields could climb to 6%, a level not seen since mid-2000. That's especially true if the Fed ends its rate cuts and lifts the Fed funds rate to 5 to 5.25% in 2 years from the current target range of 4.25 to 4.5%. A 6% Treasury yield could translate into a 7% yield on corporate bonds. And this yield level can be problematic for the equity market, Blitz concludes. Institutional equity market investors will likely reassess allocations, and 7% yields could accelerate the natural bias for a net outflow from the equity market among aging baby boomers. The current near 5% Treasury yields only look high compared with the 1.5 to 2.5% yield levels that prevailed in the decade following the financial crisis of 2008 to 2009, notes Richard Silla, who literally wrote the book on the subject. One of the lessons of this history of interest rates is that long-term interest rate cycles typically run for 20 to 40 years, Silla tells Barrons. Yields bottomed around 0.3% during the COVID-19 market panic of March of 2020, said Michael Hartnett, chief investment strategist at B of A Global Research. Although Hartnett predicts that bond and stock markets will rally later this year as the 10-year yield dips under 4%, he sees rising bond yields as the number one long-term risk faced by investors. Until the post-COVID updraft, yields had been tumbling. Interest rates fell over 4 decades, starting in 1980 with staunchly anti-inflationary monetary policies, smaller government and deregulation, and broad globalization that saw the fall of the Soviet Union, China's emergence in the world economy, and the North American Free Trade Agreement, or NAFTA, Hartnett says. After the financial crisis, that free market orthodoxy was flipped with interventionist fiscal and monetary policies. Central banks drove policy rates to zero or below in Europe and Japan, which was augmented by massive purchases of bonds to inject liquidity, known as quantitative easing. That bond buying accommodated deficit spending by governments while lifting asset prices. At the same time, Hartnett says, populism took hold internationally, culminating with Donald Trump's first presidential victory in 2016 and his re-election last year. Fiscal policies turned to extreme excess, with the U.S. budget deficit exceeding 6% of GDP in fiscal 2024. At $36 trillion, the national debt exceeds the size of the U.S. economy. All of this makes one wonder whatever happened to the bond vigilantes of a previous era, says Martin Barnes, a former chief economist at BCA Research. In the 1980s and 1990s, these bond investors would rebel when fiscal and monetary policies diverged from practices that had brought interest rates down from the stagflationary 1970s. They would drive bond prices down and yields up. Some hint of the vigilantes came with the abnormal rise in bond yields after the Fed cut last year. Silla sees that as a reaction to easing monetary policy while inflation still ran close to 3%, which is above the central bank's 2% target. Eventually, Barnes expects bond vigilantes to return, forcing the government to pay a fiscal risk premium. It's unknown when they will exact that price. He notes that economists Carmen Reinhart and Kenneth Rogoff posited after the financial crisis that a debt-to-GDP ratio of 90% would cause economic problems. Yet U.S. total government debt exceeds 120% of GDP, and it still hasn't set off alarm bells. Hartnett thinks the new administration could surprise with its spending curbs. He sees both a devilish Trump and an angelic Trump, with the latter slowing the deficit's path. Treasury Secretary-designate Scott Bessent has set an ambitious 3-3-3 plan, consisting of halving the deficit to 3% of GDP, real economic growth of 3% annually, and boosting U.S. domestic oil production by 3 million barrels a day. But BTIG Washington analyst Isaac Boltanski is skeptical, saying deficit hawks are the most endangered species in Washington. The Department of Government Efficiency, or DOGE, led by Elon Musk, is unlikely to make a dent in the deficit. Consider that in 2024, almost 60% of the $6.75 trillion in federal spending went for Medicare, Medicaid, and Social Security, while 13% went for interest on the national debt and about the same amount for defense expenditures. Discretionary non-defense spending, the likely target for cuts, accounted for only 13% of all expenditures. The CBO, Congressional Budget Office, projects the deficit to total 6.2% of GDP in 2025, shrink to 5.2% by 2027, then climb again to 6.1% by 2033. Since the Great Depression, deficits have exceeded that level only during and shortly after World War II, the 2007-2009 financial crisis, and the coronavirus pandemic, the CBO said. The CBO's outlook embodies optimistic assumptions. It assumes no recessions in the coming decade. It's based on current law, notably the expiration of the Tax Cuts and Jobs Act of 2017, signature tax measures of the first Trump administration. Renewal of the tax law, a major objective of Trump's, would add about another $4 trillion to the debt over the next decade. And that's before adding goodies like exempting tips and taxes from overtime pay, as he promised on the campaign trail. No one knows how much tariffs will offset the shortfall at this point. The CBO also assumes bond yields will be lower over the course of the next decade. It forecasts a 4% average 10-year Treasury yield for 2025, falling to 3.9% in 26 through 29, then 3.8% for 2030 through 2035. Some form of fiscal discipline may be the path to fiscal sustainability. The key is for interest rates to be lower than the growth of nominal GDP. The federal debt was pared from a peak of 106% of GDP in 1946, right after World War II, to just 23% by 1974, in large part because of the strong growth in post-war America, but also because rates were suppressed artificially. More likely, interest rates will stay high. Bond investors are apt to demand a higher yield premium to compensate for the risk of persistent deficits and the resulting inflation they could produce. The big warning flag for B of OA's Hartnett would be investors fleeing both treasuries and the U.S. dollar in a global vote of no confidence in America. Nobody knows if or when that so-called riot point comes, but it is the major long-term risk facing investors in both bonds and stocks, with major consequences for anybody needing to borrow money. From the Tech Trader section of Barrons for January 27th of 2025, the Stargate Project, big ambition, few details. This is written by Adam Levine. Tech leaders gathered at the White House this week to announce an ambitious new joint venture named the Stargate Project. You've heard about it in some of the articles I've been reading, aimed at building new artificial intelligence data centers in the U.S. The effort promises investment of $100 billion in the first year and $500 billion over 4 years. But details remain sparse. SoftBank CEO Masayoshi Son will handle the financing. CEO Sam Altman of OpenAI will contribute his overall AI expertise, and Oracle Executive Chairman Larry Ellison will oversee the build-out. All three joined President Donald Trump Tuesday for the Stargate announcement. MGX, a new AI investment firm in the United Arab Emirates with ties to the government there, will be a financing partner. Microsoft, NVIDIA, and SoftBank-owned ARM Holdings were named as technology partners. There are several unanswered questions about this project, the most important being where the money's going to come from. SoftBank has about $38 billion in cash and short-term investments on its books and $80 billion in long-term debt. The firm raised $100 billion for its Vision venture capital fund but struggled with a follow-up Vision Fund 2. SoftBank's stake in ARM was worth over $140 billion as of Wednesday, and it could choose to sell shares to help finance Stargate. Oracle has about $11 billion in cash and $80 billion in debt. OpenAI is a startup, still dependent on investor cash. It raised $6.6 billion in October. MGX may shoulder much of the financial burden, but it isn't clear what resources it can muster. MGX has 3 current investments, according to FactSet: OpenAI, Elon Musk's xAI, and another richly valued startup, Databricks. Mubadala, the UAE Sovereign Wealth Fund, is an MGX investor, and according to its website, Mubadala has about $300 billion of assets under management. Among other partners listed by MGX are BlackRock, Silver Lake, Bain Capital, and Vista Equity Partners. Those are rich pockets, but $500 billion rich? We don't really know, and the Stargate partners aren't providing information. SoftBank wouldn't comment to Barrons on the sources of Stargate funding. NVIDIA and ARM offered general support for the initiative in their replies, but didn't clarify their roles in the partnership. OpenAI's own press release announcing the project didn't offer financing details. Musk quickly cast doubt on the whole initiative. They don't actually have the money, Musk, a key Trump ally, wrote on X. SoftBank has well under $10 billion secured, and I have that on good authority, quote unquote. OpenAI CEO Sam Altman defended Stargate's funding in a social media post. Wrong, as you surely know, he said in a reply to Musk on X. This is great for the country. On Wednesday, ARM CEO Rene Haas didn't provide details on financing but told CNBC, I would say, rest assured that you would not have the individuals you saw yesterday and the president all together with such an announcement if there wasn't a lot of backing from a financial standpoint. The debate and questions about funding highlight the significance of the expenditures and the complex nature of AI model building and deployment and the infrastructure needed to support it. For a sense of Stargate's proposed sale, Microsoft offers a good comparison. Microsoft is projecting $80 billion in capital expenditures in fiscal 2025, ending in June. That's an 80% increase from 2024, which was a 58% rise from the year before that. Stargate wants to ramp from nothing to $100 billion, 25% larger than Microsoft's planned outlay, all in 1 year. It's a big ask, considering Microsoft had $73 billion in annual free cash flow, and Stargate currently has none. Microsoft, NVIDIA, and ARM were left out of the equity discussion, suggesting that their balance sheets won't contribute to the effort. Microsoft has been OpenAI's biggest investor. Its Azure cloud is the home to OpenAI's signature ChatGPT service. The new dynamic suggests bigger AI ambitions for both Microsoft and OpenAI. It's entirely plausible that the Stargate news was not forced on Microsoft, but that Microsoft viewed exclusively financing OpenAI no longer made sense from a risk and capital allocation standpoint, said UBS analyst Carl Kierstead in a note to clients. Put another way, OpenAI's massive scale ambitions may have been running up against Microsoft's desire to exclusively serve them. Microsoft referred Barrons to a Tuesday blog post that briefly alluded to Stargate, but went on to redefine its close relationship with OpenAI. Most of their agreement through 2030 remains, the blog post said, but Microsoft's Azure cloud platform will no longer have exclusivity on new OpenAI computing demand, though it does retain the right of first refusal on new cloud business. While the partnership remains, there are cracks forming, and they're likely to reverberate across the tech landscape. Income investing from Barrons of January 27th. Muni investors wake up to the perils of climate risk by Amy Stone. Just as Los Angeles seemed to be regaining control after 2 weeks of devastating fires and was preparing for long overdue rain, a new fire sprang up Wednesday. The Hughes Fire near Castaic quickly covered 3,400 acres, triggering evacuations and road closures. No, the Los Angeles fires, already considered the biggest natural disaster in U.S. history, aren't over. Loss of life is now at 28, and the financial damage is estimated at a staggering $275 billion, most of it uninsured. We have made no assumptions about when this is done, says Dan Close, who leads municipal bond strategy at Nuveen. That would be foolish of us. For residents, this is a nightmare. But for investors in California's muni bond market, it's a wake-up call. Yes, some munis have fallen in price, but those bonds aren't at risk of default, and they should recover when aid and insurance payments start flowing. The difference is that longer term, more strategists are incorporating weather-related risk into their forecasts. The municipal market's not going to forget what happened in January of 2025 in California, says Tom Kozlik, head of municipal strategy at Hilltop Securities. Folks were factoring the increased magnitude of weather-related risk into their decision-making process. Now, some have started doing so. Given the generally stable nature of muni bonds, the wake-up call didn't register in a major sell-off. The Nuveen California Municipal Bond Fund, for example, is down just 0.27%, or 27 basis points, this year through January 22nd. The declines mostly involve specific downgraded credits. On January 13th, S&P Global Ratings downgraded the LA Department of Water and Power, or LADWP, 2 notches to single A, which is still a high rating. And on January 15th, it put AA-rated City of Los Angeles and AA-rated Altadena Public Library District on watch for a credit downgrade. Spreads of widely held LADWP issues have widened the most, mainly over concerns about risk of lawsuits if the utility is found to blame for the blaze. Even though there hasn't been any finding of fault, they're trading like some fault was assigned to them, says Jeff Timlin, who manages the tax-exempt fixed income strategies at Sage Advisory Services. He estimates that spreads widened about 50 basis points, so that a 10-year issue trading at 3.2% would now be closer to 3.7%. Spreads for City of Los Angeles and school bonds have risen more like 20 to 30 basis points, to yield roughly 3.5% by the same measure, Timlin estimates. Concerns relate to lost tax revenue, given that homes and schools will take years to rebuild. Still, with yields at these levels, some buyers are swooping in when bonds become available, he says. The city's size, the state's economic strength, and confidence that federal aid is coming lead investors to believe these credits will meet their obligations. Will we have a rash of defaults using history as a guide? We don't think so, says Close. Federal aid is key. President Donald Trump suggested on January 22nd that he could place conditions on California receiving aid, yet strategists don't expect a major departure from past practices. We hear it. We're aware it's out there, says Jennifer Johnston, Director of Muni Bond Research at Franklin Templeton. We think it will get resolved and we'll see traditional support at the federal level that we've seen in past natural disasters. Could there be an opportunity for investors? Perhaps, but the most important takeaway is the benefit of national diversification, says Timlin. In high-tax states, many investors want to stick with state issues, but you're concentrating your risk profile, he says. Unfortunately, as beautiful and wonderful as California is, environmental risks are heightened. A national fund may make more sense. And we'll move to Market Week in the Barrons Magazine of January 27th. The Trader by Paul R. LaMonica. Stock Markets at the Mercy of Big Tech and the Fed by Paul LaMonica. If the stock market were a boxing ring, you'd have the Magnificent Seven in one corner and the Federal Reserve in the other. Investors could be the winner. They were this past week as earnings trickled in and President Donald Trump's policies were so far benign. The S&P 500 closed at a record high Thursday and rose 1.7% for the week, while the Dow Jones Industrial Average gained 2.2% and the Nasdaq Composite was up 1.7%. Now viewers are turning to the main event, Apple, Microsoft, Meta, and Tesla all report earnings the week of January 27th coming up, and they might seem like a good bet to jolt the markets higher. Netflix, though not a member of the Magnificent Seven, surged after it reported stellar fourth quarter numbers, and investors should be pretty pleased if the four tech titans can do the same. The results should be exceptional, says Nanette Abuhoff-Jacobson, global investment strategist at Hartford Funds. Meta's profits are expected to climb more than 25%, for example. Unfortunately, solid growth may already be priced into the Mag 7 stocks. Phil Blancato, chief market strategist at Osaic, thinks investors shouldn't chase that momentum. If you're already in tech, enjoy it, but don't buy now, he says. His chief worry? Valuations. The Roundhill Magnificent 7 exchange-traded fund, ticker MAGS, is trading at 31 times earning estimates for this year, and that leaves the Fed primed for a knockout. The central bank is no longer expected to cut interest rates January 29th, and investors aren't pricing in high odds of an ease at the Fed's March meeting either. Still, many on Wall Street believe it could deliver one or two more rate cuts this year. The Fed probably thinks it's in a pretty good place with regards to policy, says Tracy Manzi, senior investment strategist at Raymond James. It has room to be patient and see how data unfold. She thinks the 10-year Treasury yield may not move much from current levels of around 4.63%, staying in a range of 4.4% to 4.8%. But don't forget Trumponomics, the potential for resurgent inflation due to possible tariffs and any crackdown on immigration that reduces the workforce and pushes wages higher, could lead Fed Chair Jerome Powell to start sounding more hawkish and spook a market that only recently moved past his heel turn at the December meeting. If only it were that simple. While Lawrence Werther, chief U.S. economist at Daiwa Capital Markets America, isn't expecting big moves from the Fed, he thinks it will ease in March and June, and then wait to see what Trump's fiscal policies do to consumer prices. The Fed's going to front-load rate cuts and then prepare for some inflation pressure, he says. If inflation doesn't come roaring back, then the market should be able to focus more on strong earnings, and longer-term bond yields should start to retreat. That will likely keep investors happy, as well as Trump, who has already begun to demand lower interest rates. It might be a long shot, but if it works out, it would be a victory by unanimous decision for Wall Street. 9 promising REITs. REITs. It's been dark times for real estate investment trusts in recent months. Rising mortgage rates have wreaked havoc on the residential market, while commercial real estate remains a quagmire as people continue to work from home. The Real Estate Select Sector SPDR ETF, under XLRE, returned just 5.1% in 2024, while the SPDR S&P 500 ETF, under SPY, gained 25%. But the sector may have finally bottomed. Valuations seem reasonable, and if long-term bond yields continue to slide as inflation worries subside, real estate stocks may regain their appeal as bond proxies thanks to their generous dividends. The yield for the real estate SPDR ETF is 3.4%. But REITs aren't just for dividend investors. Some may also benefit from the animal spirits that have boosted the overall stock market since Trump's election in November. The real estate SPDR ETF has warehouse giant Prologis, wireless infrastructure company American Tower, and data center leaders Digital Realty and Equinix as top holdings. Prologis President Dan Letter said during the company's fourth quarter earnings conference call that was earlier this month that there's been a boom in demand since November, with previously stalled deals now being signed. The stock gained 8.6% this past week. Other logistics and infrastructure REITs also stand out. Morningstar analysts recently identified American Tower competitor Crown Castle, which has a dividend yield of 7%, as well as Americold, a leader in cold storage warehouses for perishables, pharmaceuticals, and chemicals, which yields more than 4% as top picks for this year. The analysts noted that Crown Castle should benefit from more spending by big carriers like Verizon and AT&T. And Morningstar argues that Americold stands to gain as food manufacturers continue to ramp up production and supply chain issues and labor shortages abate. But residential real estate is enticing despite rising mortgage rates. Fund managers at PIMCO said in a report in December that they like single-family rental properties as well as student housing, due in large part to housing shortages throughout the U.S. Morningstar likes Sun Communities, which is a big owner of second homes and vacation properties in Florida and Michigan, two markets that are attracting more retirees. The stock yields 3%. Investors should tread cautiously in other parts of the sector, particularly office REITs. The Morningstar and analysts suggested that if investors do want to bet on offices, they should look at companies catering to the life sciences sector, because biotech companies looking to develop new drugs will need space. And there's growing demand for medical offices as well. Kilroy Realty and HealthPeak Properties, which both yield nearly 6%, could benefit. Just continue to keep an eye on Treasury yields. Investors in REITs should closely monitor the bond market and be prepared for potential volatility in the REIT sector, said Kevin Flanagan, head of fixed income strategy at Wisdom Tree in a recent report. The good news, though, is that these worries may already be priced into the stocks. REITs are trading at about 18 times earnings estimates for 2025, below their 5-year average. They also trade at a discount to the S&P 500's 22 times, when they've historically traded at a market multiple. And, oh yeah, the juicy dividend yields don't hurt either. An RFK Jr. proof healthcare stock. Healthcare stocks have been running scared since the election due to concerns about what could happen if Robert Kennedy Jr. is confirmed as Trump's Health and Human Services Secretary. Thermo Fisher Scientific never got the memo. RFK Jr.'s skeptical comments about vaccines have raised worries about a possible slowdown in drug development in the life sciences industry. The Healthcare Select Sector SPDR ETF, known as XLV, is down nearly 3% since Election Day, compared with a 3% gain for the S&P 500. Not Thermo Fisher, a medical instruments and equipment giant that makes things like fluorescent dyes, cell counters, test tubes, and electron microscopes. Its stock, at $574.82, is up about 2.5% since early November and more than 10% in January. The reason? RFK Jr. may disrupt parts of the pharmaceutical industry, but he's unlikely to cause research to grind to a halt. We're optimistic on medtech, says Shams Afzal, a portfolio manager at Carnegie Investment Counsel, which owns Thermo Fisher stock. There's stability in biotech funding. While the specter of RFK Jr. looms large, the need for major healthcare companies to develop new blockbuster drugs is more important. That should benefit Thermo Fisher, which sells just about everything a drug maker needs for diagnostics, says Shivani Vohra, a portfolio manager at Parnassus Growth Equity Fund, which owns the stock. The company itself seems unperturbed by the changes in the political landscape. The J.P. Morgan Healthcare Conference earlier in January, Thermo Fisher CEO Mark Casper said that there's quite a bit of enthusiasm among its pharma and biotech customers, despite questions about potential tariffs and new regulations from Health and Human Services. Investors should find out if such optimism is warranted when Thermo Fisher reports its fourth quarter results January 30th and potentially updates its outlook for 2025. Analysts are forecasting earnings to increase by 5% from a year ago, and they're predicting momentum to accelerate going forward, following post-COVID declines in 22 and 23, with growth hitting 7% in this year, 11% in 2026. At just under 25 times forecast earnings for 2025, the stock's trading roughly in line with its historical averages, but at a discount to rivals such as Danaher, Mettler Toledo International, and Bio-Techne, which all trade at multiples in the low to mid-30s. Wall Street's fairly bullish as well, with 27 analyst buys versus only 5 holds. The consensus price target of about $650 is some 13% higher than current levels. Let investors in Pfizer and Moderna worry about Trump 2.0 and RFK Jr. Thermo Fisher stock should have a healthy year. And with that, we've come to the end of our reading of Barrons Magazine for January 27th of 2025. This is your reader, Eric, saying be well, be safe, look after each other. Remember our veterans, especially those we've lost recently. Bye for now.